You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Hey guys, welcome back. We did it. We're at episode 100.
We made it.
We made it. How you doing, Hamish?
I'm doing well. I'm excited to do this episode. How are you doing?
Yeah, it's going to be great. I'm really looking forward to it, actually. We actually had some people call in.
We did.
I was so nervous that we were going to get absolutely no one. So thank you to everybody that submitted an audio question. You know, I was thinking, if this works well, like I'm not sure if it will work well. I hope it does. But we could just do this for the Q&A section of the podcast.
Yeah, I think it's a really cool idea to actually have different people sort of coming on for a little bit for like 20 seconds and being able to ask a question. I think that's a good idea. Yeah.
It's kind of weird. Like we look at the statistics and we know that there are X amount of people that are watching each week or listening. But until you kind of hear people comment on what you're saying, like through audio and ask a question, then I don't know. There's just something that makes it sink in that actually like, I don't know. I don't want this to sound wrong, but it's like, yeah, these are, you guys are real people out there. There are, this many thousand of real people that are actually listening to whatever the hell we come up with each week.
No, that's actually so true. When you're just reading comments, there's a significant disconnect, I think, in your head as to like whether that's obviously it's a real person, but it's so true. When I was listening to some of these questions, it's just like, wow, it's like there's real people out there listening. And it's like the same when I ran into someone at the supermarket the other day who watched the channel. And
oh my gosh.
It's kind of just like mind blowing when that happens. It's like, wow, okay.
Yeah, it's kind of weird. I'm just so awkward. I need to get less awkward when somebody like passes me, like at the shops or if I'm out on a walk and you're that guy from that YouTube channel. I'm like, yep. And I'm like, what do I say next?
Yeah, it always catches me by surprise.
Yeah.
Doesn't happen very often.
It's always in the most, like, the first time I ever got recognized from the YouTube channel was when I was working at doing my physio job. So I was like, on the clock, I was working, and then this person was like, hey, you're that guy from the physio. I was like, oh, yeah, you're that guy from YouTube. I was like, oh, yeah, that's me. It always seems to happen at the strangest times, too.
Yeah, I think my first time was at JB Hi-Fi. I was trying to buy something.
Your first time was at JB Hi-Fi?
Come on, Brandon. This is a G-rated podcast, all right?
Mind out of the gutter.
Get your mind out of the gutter.
Sorry, everyone. Oh, dear. Anyway. Oh, gosh. So, yeah, anyway, I'm excited. Hey, I have had a bit of a follow-up. You know how we were talking so much about antitrust last week?
Yes.
It got me thinking, so it's deemed anti-competitive and illegal for companies to cut deals with other businesses to try and further their own monopolies. Yet somehow it's legal for companies to pay political parties to essentially do the same thing. Did you ever think about that one?
Yeah, it is pretty strange. It is. It's a weird world when businesses like money meets politics, because that's where there's a significant imbalance. Obviously, if you have a big business that has a lot of money, you can assert a lot more influence than the individual person. And obviously in politics, it's supposed to be like, one vote per person. We each get our own voice. So it is a strange world where that combines. Certainly some things that can be fixed in the future, I'm sure.
I would say that is the most anti-competitive kind of action that you could possibly get.
Yeah.
But there you go. That's a quirk in the system, isn't it?
Yeah, it is. It is. And it's one of those things that maybe we'll look back in the future and be like, wow, is that really the way we did things back then?
Yeah. Well, I don't know if it's ever going to be changed because,
that's true. Yeah.
It benefits the people that write the rules, and the people that write the rules write the rules. But anyway, you could talk for a long time about that. But anyway, I just thought about that during the week, so I thought that would be an interesting follow-up. Also other news. Geez, I was gonna save this for saying this on my channel, but something happened during the week. Hamish.
Oh no.
Something big.
What happened?
Very big. I might have bought a Tesla.
Oh, that's right. That's awesome.
Yeah.
When are you expecting to get it? In a few weeks, is it? What's the delivery time?
I spoke to the Tesla rep and they said that it should be here in December.
Wow. So that's amazing. Yeah, I had no idea what you were talking about when you were leading into that, but then I remembered.
Then you remember. I think I messaged you. I don't even know.
Yeah, you sent me a message. Yeah.
I sent you a message. Did I leave it to the next morning? Because I ordered the thing at 12:38 a.m.
No, I think you sent it that night. I'm pretty sure you sent it, yeah.
Sorry for annoying you. I was just buzzing and everyone was asleep. I'm like, oh man, I need to talk to someone about it, but you were also asleep, so that didn't help.
That's a big purchase to do at midnight.
Yeah, I know, right?
Jeez. Surely it's a morning.
I needed to be a little bit tired and a little bit out of it. Otherwise, I don't think I would have done it.
Oh, that's really exciting.
So I'm pumped.
I'll have to come up to Canberra and
when you can,
go for a spin.
Definitely. All right. Well, with that said, let's get stuck into it. Let's get into the sponsor and then get into your questions. I'm excited. Let's go.
Yes. So today's episode is sponsored by Sharesight, and Sharesight is an application that you can use to track the performance of your stock portfolio. And it's really good for keeping track of all of the different types of gains. So capital gains, your dividend income. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you just hold foreign currencies. And then the main reason why I personally use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, your dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/younginvestors. That's site spelled SIGHT, sharesight.com/younginvestors. And if you use that link, you can also get 4 months free when you sign up to a yearly subscription. So go check it out, try the free plan for as long as you want. And if you decide you want to upgrade to get more features, then use that link and get 33% off.
Yeah. Woohoo. Thanks, Sharesight, for sponsoring.
Cool.
All right, let's get stuck into it. Hey, man, I'm pumped for this. This is going to be so good.
Yeah, awesome. All
let's get straight into it. So I think we've got 10 or 11 questions to get through.
Yep, something like that.
So, and first question, who gets the first one? Yes. First one comes in from Sean. So let's hear it. Take it away, Sean.
G'day boys, it's Sean from Canberra here, big fan of the podcast. Look, my question for you guys is, and you've talked about this before, there seems to be a big difference between US and Australian stocks, where US stocks tend to be more growth focused and Australian stocks tend to be more dividend focused. And I was just wondering if you have any insights to why you think that might be. Is it, factor of the tax system, or just that Australians tend to want dividends more than they want growth? Anyway, thanks boys. Congrats on the 100.
Yeah, so Sean, you're definitely right. Talking about it is definitely a big factor of the tax system. Because when Australian stocks or Australian businesses start getting really large, then there's quite a bit of pressure on them from shareholders just to start paying, really nice juicy dividends, because of course they get to exploit the imputation credit system here in Australia, which is definitely a big help to shareholders. It doesn't help the company, but it does definitely help the shareholders. So essentially with the imputation imputation credit system, normally what would happen is that the company gets taxed. Then after the company gets taxed, it pays the dividend, and then you receive that dividend as income, and then you have to declare it as income, so that also gets taxed. So with the imputation credit system, you get a tax credit personally for the 30% company tax portion that's already been paid. So essentially what it means is that if your marginal rate was 30%, and then you received your dividend income, and then your tax on that dividend would essentially be cancelled out by the 30% imputation credit that you got for the corporate tax. So I think that's definitely a big reason why a lot of Australian companies, they try and they want to try and please shareholders and get as much money in their pockets. So they do definitely exploit that imputation system.
Yeah, definitely.
What do you reckon, Hamish?
Yeah, I think tax is probably going to be the main reason why there is any difference in the way that businesses distribute. That's typically what drives that decision, I would think. Another thing sort of to mention, I think in the US, and I'm not even sure if this is 100% true, but from my understanding, the capital gains in the US are taxed at a far lower rate than dividend
That's
income.
true, yeah.
So I think capital gains in Australia you still get a discount if you have long-term capital gains, but I think there is a far difference, a bigger gap between the tax on those two in the US. And as a result, I think that probably drives why a lot of US companies opt to do share repurchases instead of paying dividends. So, a share repurchase is another way that a business is distributing money. It's just that I think the way Warren Buffett describes it is a dividend is kind of like a forced distribution to every shareholder, whereas a share repurchase is an optional distribution, right? Because if you want to get some income from that business, when they do the share repurchases, typically the stock will go up, and investors that want that income can just trim some of their position. They can sell off 2 or 3%, and that's the equivalent of getting their 2 or 3% dividend. And the investors who don't want a distribution just hold on to the stock, and the value of those shares go up. So that I think that probably plays a role. But ultimately, all of the little factors that go into it, I think that would be sort of not something that we could figure out, I think. But those are probably a couple of the two major factors, I think.
No, I think you're right. Definitely. Definitely there's, for the Australian side of it, it's definitely about the dividends. For the American side of it, it's probably, the differences in, capital gains and whatnot. Because, you're right. Essentially, like, there's going to be with the money that the company makes, there's going to be 3 main ways, I guess, it can benefit shareholders. The first is if they just keep all the cash and reinvest it back into their own business and make their business bigger and your share value goes up. Yeah. Or the second is pay out a dividend, which, investors will have to declare that as income and it'll get taxed. Or you're right, the company could just do more share repurchases. So that's I think definitely that'd be more the go. Well, we've seen that be more the go over in the United States. US companies are doing share repurchases all the time.
It's definitely their go-to. I haven't seen that many Australian companies do a lot of share repurchases. I mean, no, that's right. Just from the companies I've looked at, which is not, by any means all of them, but from the ones that I've looked at, there is a far more emphasis on paying a dividend. There's really not that many Australian companies that don't pay any dividend, right? There's really not that
once
many.
They get to a certain size, it kind of just it makes a lot of sense for their shareholders anyway.
Yeah. There's definitely a number of differences between investing in the US and Australia. Another thing that I notice is I really like to find companies that have like 10 or 15 years of consistent double-digit growth, and I really struggle to find a lot of Australian companies that have achieved that in areas that I'm interested in. Whereas I look over in the US and there's tons of businesses, and maybe that's just because the US is substantially larger, that might play a role.
Yeah, true, actually. More businesses in total.
Yeah, but I tend to find the businesses that I want to invest in, businesses with really long track records, I tend to find a lot more of them in the US. Just from my personal experience. Yeah.
It probably works better with your circle of competence too. A lot of the companies that you'd put in your circle of competence will probably be American based. Because let's be real here. Like in Australia, we look at our, the big companies in Australia that have been around for a very long time and do have, the 10, 15, 20 years of history. Well, they're basically banks or mining companies or telecommunications companies. Just kind of the Australian economy staples. And to be honest, I find those companies quite boring.
You're not alone.
But boy, oh boy, do they pay some fat dividends. But so I hope that answers your question there, Sean. I think there are probably a few factors that go into it, but hopefully we've covered a few of them. So thanks for the question.
Thank you. Thanks, Sean.
And next question comes in from Nathaniel. So take it away, Nathaniel.
Hey guys, I'm a big fan of the podcast. Congrats on your 100th episode. I've got a question regarding investing in Russia, either in a Russian ETF or individual Russian businesses. And the reason that I've started looking into Russia is because of searching for value. And there's a lot of overpriced companies in America and Australia. And I was looking at the CAPE ratio, or the cyclically adjusted PE. And for a bit of context, America has a very high PE CAPE at the moment, 31. And Australia has a CAPE of 16, but Russia's CAPE is currently about 8 or 9. I've got some concerns about Russia, though, things like transparency or access to the markets or regulatory risks. And a lot of the companies are state-owned, and I'm a bit uncertain about returns to shareholders. So I'd love to know your thoughts on Russia and whether we should be looking at CAPE for value investing. Cheers.
Yeah, well, firstly, thanks very much for the question, Nathaniel. There's definitely a lot to unpack in this question. And I guess the first thing that I'd say is definitely you want to absolutely like look for value wherever you can find it. And you're definitely right that, looking to America, I actually just made a video on this the other day. Looking to America, CAPE ratios, cyclically adjusted P ratio is through the roof. Like there are a lot of very, very expensive stocks over in America. So yeah, fair enough that you're looking to other markets to try and find value. And I mean, the best investors have been doing that as well. I mean, it was last year, I remember reading that email interview that Michael Burry did, and he was saying how he was trying to find value in like South Korea and I think Japan, and Warren Buffett recently has just been investing over in Japan. He's been sinking billions into some of those Japanese companies. So I think it's definitely a fair play to try and find value wherever you possibly can. And the CAPE ratio is obviously a really good place to start. Just to get a broad overview of what's going on in, for the different countries, stock markets. And essentially it tells you what average price are investors paying for the 10-year inflation-adjusted earnings of the companies from that country. So, you're definitely right. Like the US is at about 31, so very expensive considering the average is like 16. But for me personally, and this might be totally different for you, but for me personally, investing in a country like Russia is a country I'm not very familiar with. I've never been there. I've never looked at any how their political system works or how their corporate system works or anything. I haven't looked into any sectors. So for me, if I were you, it would immediately be a question of circle of competence for me, because I'm not sure of the accounting standards. I'm not sure of the political factors. As you're saying, a lot of the businesses have state ownership. So you're right. How does that influence the company's relationship with the retail shareholders? I'm just not sure. But then again, that's just me. That's just Brandon Vanderkolk from Canberra. So you might be completely you might have been researching Russia for ages and really have a good understanding of it. And then that's totally fine. If that's sitting right in your circle of competence and you're finding some great companies, as long as they fit the good moat, strong moat, good management kind of formula, then it makes sense to try and find value wherever you possibly can. I mean, remember, was it Warren? Yeah, Warren Buffett. He said it was even this year or last year that basically all investing is value investing. Yeah. Even though it takes a slightly different form depending on who you talk to. At the end of the day, that's all we're trying to do. We're just trying to find good places to put our money to make good returns over time.
Yeah, I mean, I really like that statement from Warren Buffett about how everyone is doing value investing. I think it's so true. I think to make a distinction between value and growth, it doesn't really make any sense, because even if you're buying a high growth company, you're still trying to get more out of that company in the future than what you paid for it. And over the long term, that's driven by the profits that the business produces. So if you're buying a high growth company and you're paying a high price for it, you're just doing value investing with really high expectations of the future. So I really like that quote from Warren Buffett. But I think I sit probably in the same camp as you, Brandon, in that it's probably outside of my circle of competence, like a lot of other emerging markets. I mean, a couple of the things that you mentioned, like the state ownership of businesses and how other laws and regulations and how government is involved in businesses in Russia, is a lot of stuff that I don't understand. And I mean, even things like what Russian culture is like, what products and services that consumers are interested in, and that sort of thing is very different to the US, for example, or Australia.
Yeah.
So for me, I think if I was looking to invest in individual businesses in Russia, I think that would be extremely challenging. I think that it would. I don't know if I will ever. I'll never say never, but at least over the next few years, that's not something I plan on doing. In the same way that I probably won't do that for other emerging markets. But you're not talking about investing in individual businesses. You're talking about an ETF, and I think that if you are going to be investing in foreign markets, then an ETF is certainly a good way to do it. For me, if I was looking to invest in Russia, which at the moment I'm not, but if I was, then I would probably find an emerging markets ETF that doesn't just invest in Russia, but gives you some diversification between a number of different growing markets. So that way you're not completely at the mercy of, well, you're certainly not at the mercy of one individual Russian business, but then you're not at the mercy of the Russian market itself.
True.
You can grab some diversification from all of the emerging markets, and then therefore you will benefit from the ones that end up growing substantially. But
I guess politically as well, that's probably safer because like if you've got just an emerging markets ETF which covers a few different economies, then you know if there's some sort of political issue that affects the whole of one particular emerging market, one country, then that kind of diversifies you against that potential risk, I guess.
Yeah, and I mean, like for the Australian government and legal system at the moment, like I feel pretty confident that the way that it's set up is pretty solid, that it's probably not going to change substantially over the next couple of decades. And I don't know about Russia specifically, but in emerging markets in general, that's not always the case. There's different legal systems, different governments, and a lot of them are a lot less stable than other regions. And that also has an impact. But personally, I just feel more comfortable sticking to companies and brands that I see on a day-to-day basis. Or at the very least, as I kind of alluded to, that businesses that operate in a legal system that I somewhat understand. So that's kind of where I sit in terms of Russia. But as I said, if I was going to invest in there, I would probably look for a broad emerging markets ETF or even just a global ETF, just to grab a little bit of everything. All right, so we can now move into the third question. So question number 3 comes from Neil. Take it away, Neil.
Hi, Hamish and Brandon. Neil here. Solid effort on cracking 100 episodes, lads. Really good going. I'm a big fan of both the podcast and both YouTube channels. Really good content, guys. Keep it up. Hey, just a quick question. Have you ever floated the idea of possibly throwing a young investors conference or a bit of a get-together, catch-up maybe once a year? I think it'd be pretty cool, and I reckon a lot of people would be interested in it. Anyway, would love to know your thoughts, guys. Cheers. See ya.
Thanks for the question, Neil. I think that's a really good idea. I think we've probably been thinking about doing this for a while, right? This has been something that we've spoken about for a long time. It's tough to coordinate something like that. I think we'll certainly be doing something along those lines in the future. I certainly think it would be a good idea. We could also get some other creators involved as well, some other people in the finance space to kind of involve a few different audiences and bring everyone together. And I know that
that would be cool.
Yeah, I mean, there's a lot of people who watch content on YouTube, and they watch a number of different people. So if we can get a number of different people in together, I think that would be a really good idea.
I'd enjoy it. That'd be so much fun. It's just it's always so much harder to organize these events than what you think.
Yeah.
Like back when we had just started out and only maybe a couple hundred people were listening to the podcast, it would have been easy. We could have just said, hey guys, we're going to be hanging out in Melbourne, meet us at, this Subway and we'll go get a sub and then just hang out. Which would have been very nice to do back then. But now it's
the Young Investors Investor Conference at Subway.
But but back then you could have just done something like that. But now you're right, Neil. We probably have to do something more like a conference, which would require a venue and so many other factors. And we'd have to, we'd probably have to. I don't know if we probably have to, we wouldn't make money from it, but we'd have to cover our costs. So that means that it would probably have to cost a little bit of money to go to, which means that we would have to make sure that the event provides that amount of value so that everybody feels like they're getting something out of it. So it sounds like, I really want to do it. And I think if next year, maybe when we're allowed to travel again, if we could do one in Sydney and one in Melbourne. I think that would be a good start.
Definitely.
But yeah, I'm not sure what we do. Maybe we'll do something like a bit of a conference and then a meet and greet, or maybe, something. I'm not sure, but
Yeah.
I would very much like to do that. That would be awesome because, even like just receiving these audio questions from you guys out there, it's kind of like, oh, this is so exciting, It gives us kind of that connection between you guys, like a real connection. So I'd certainly like to do something like that in the future, but. Yeah, we'd have to plan it. We'd have to plan it well. But yes, definitely. We'll definitely do it. And every time, I don't know, when we travel, like when you go up to Sydney and maybe you post on Instagram, or if I'm down in Melbourne and we post, then everyone's just like, oh my God, you guys are in my city. Like we need to do a catch up. And then it's like, man, like I wish I'd organized something, but it's a little bit too little too late when you're already there. So
yeah, the one thing I would be, if we didn't do it in a really structured way, the thing I would be nervous about is if we told people to go somewhere and a substantial amount of people came. And I don't know if that would be the case, but that's what I would be nervous about. I think now that we've got it, at least you have a huge audience now. There's a good chance that a lot of people would come to something like that. So I think we would have to structure it in some way.
I've just seen YouTubers do these sort of meetups wrong too many times. I've seen too many fails, like where they haven't thought about capacity, or they haven't thought about security or anything like that, and it just turns into a complete mess. So I think we'd have to do some sort of structure where we get somewhere booked that has a certain amount of capacity, so we print that amount of tickets and everything's kind of very structured. But yeah, it's just a matter of organization. Well, actually, the first things first, it's a matter of being able to go anywhere.
Yeah, I can't.
That's our first restraint.
Yeah, I can't leave Melbourne. So
yeah, exactly. And I can't come to Melbourne. Or can I come to Melbourne, but once I come, I just can't leave or something?
God, I
don't even know.
I have no idea there's so many rules at this point. Yeah,
I think Melbourne. I think Victoria's almost. I think they're debating just taking that chunk out of Australia and putting it in the middle of the ocean. At this point,
may as well. I think last week I can have one person over now. So
nice.
Yeah, and we're allowed out of our house for more than 1 hour. So
nice.
Getting our freedoms back.
Getting your freedom back. You sound like some sort of pet.
Yeah.
You're allowed to take Hamish for a
My
walk.
owner
Yes,
lets
you
me
can go
out.
for longer than an hour.
Unsupervised.
Yeah. Oh my gosh. This is unreal. Freedom. Oh dear. Anyway, all right. Shall we move on to the next question?
Yes. So question 4 came from Michael. Thanks for the question. Take it away, Michael.
Brandon and Hamish, how are you, legends? You've been a solid part of my lockdown routine over the last year in Melbourne, so mad props for that. Cheers for the good times. My main question would be, when did you first both start getting your head around business, markets and investing? Like, were you the kind of kids that were like analysing the primary school canteen market in your early years, or did it sort of eventuate later on in life? Just keen to hear a bit of an insight into your journey into this world, and if you've had any sort of main role models or influences.
Thanks for the question, Michael. I think it's a really good question. So in terms of, in terms of investing in stocks specifically, that wasn't something that I was aware of until I finished high school. Around that time was when I started to read books, and I obviously, after high school, went to university to study finance. So that's kind of where that began in terms of stocks and investing specifically. But prior to that, I kind of was always a little bit fascinated with businesses, and maybe at the time I wasn't entirely aware of what I was doing. Like, I wasn't quite sure that I was actually, running businesses or anything like that. But I just these were just kind of things I did. And looking back, it's kind of funny, but in high school, I started a couple of businesses. I had a hat business. I sold these.
I remember you telling me about that.
Yeah.
I think you mentioned that on the podcast one time.
I think I did. Yeah. So that was when I was. I think that was the one up we did in Sydney. I think I spoke about it on there. that live podcast. But yeah, so that was when I was 15, and that, I mean, it was tiny, right? But
That's right. It was Triple H. Hamish Hodder's hats.
Exactly right. No, so I just found this wholesaling website, and a lot of people wanted hats, so I just took orders, and then I sold them for more. And then
Sick.
while I was thinking about this question, I just remembered something that I did in primary school. So in year 6, and I want to know if other schools did this. I think this was a really strange thing to do, but our teacher in year 6 had like Monopoly money. And then if we answered questions correctly and were nice in class, quiet in class or whatever, the teacher would give us this Monopoly money, and then we could save it up and use it to get out of homework. I don't know if any other school did this, but that was kind of, and then there was other things you could do, like you could spend them on other things. I can't really remember, like you get extra free time or something. I don't know. But what I did was
here we go.
Instead of actually just earning the fake, so instead of just doing the work and being quiet and actually earning the money from the teacher,
Nah,
none of that. I started making these like desk organize. I would just use paper and like make these little desk organizers and little recycling bins for people at their desk, and then I would just sell them to other kids for their Monopoly money.
Wow, that's fantastic.
And I had completely forgotten about this until I looked and was answering this question, and I remembered that. So, but I mean, I think like whenever, when that's happening, I'm obviously at the time, I'm not thinking, oh, this is a business. This is great. Like I don't even think, and I think I mentioned this on another podcast, I don't think I was even aware that you could start a business from scratch and run that as a full-time job until I was like 18. I just thought businesses were always just like, I don't know, like either your family had to have a business for you to get involved. I think that's genuinely what I thought for a long time. But yeah, looking back, I did have some kind of experiences with business early on.
Yeah, I think I never got into the stock market until it was kind of like my last year of uni, when I was getting ready to start working, become a full-time physio, and then I realized that entry-level physio jobs are not going to pay you a huge amount of money. Of course, I was always someone that thought pretty big, so I wanted a way to try and compound money and turn my money into more money. So that's when I started getting into the stock market. However, I've really always had, without knowing it, I've always had an interest in money and in business. Like when I was younger, I used to try and convince people to let me mow their lawns for cash and, all that sort of stuff. I've always been very focused on, putting myself in a better financial position, like accumulating cash and trying to, like, even when I was a kid, trying not to spend money on things that I didn't need to and blah, blah, blah. But I never really thought about it back then. There's kind of just traits that were there without me really realizing what they were. But yeah, it was only in uni that I got into the stock market, and now I'm like, obviously we're both super into it.
Really?
And
Wait,
and super into business as well. Yeah, it's when you're young, when you're in your 20s, it's such a good time to get your head around business and actually think about starting a business. Like if you can learn these sort of skills when you're 18, 19, 20, somewhere around there, and you really understand, things like compound interest or starting your own business and how to grow a business and that sort of stuff, then man, that can really be a very powerful thing for you later in life when you've started so early, especially even if it's just like ETF investing, passive investing style in stock market. If you start that when you're 18, even that, there's a huge difference between someone that starts when they're 18 versus 28, just 10 years later. There's a massive, massive difference by the time you're like 65. So
yeah, I also think it's really important, or it's not important. I mean, I think it gives you a huge advantage if you can learn about investing and learn about managing sort of your budget and money before you have a lot of expenses and a higher income. So if you can do that at around 18 or below, where maybe you have a part-time job, but you don't really have any expenses, you're kind of just buying random stuff that you don't really need. If you can get into a good habit then of saving a good chunk of your whatever you're making from your part-time job, or whether you're mowing the lawns or whatever it is that you're doing to make a little bit of money, and then investing some of that money, then when you do start to have real expenses and you have a full-time job and you're actually making a good amount of money, those habits kind of follow on. Because once you start making a bit of money and you start having real expenses, it can start to get very complex very quickly. So having that foundation is super important, I think.
Yeah, definitely. Yeah, you want those rules in place before you get into the more complicated situations. I mean, I find it crazy. I guess it's just because it's not me, but people that haven't really ever learnt those money lessons, those lessons about, business and cash flow and whatever. And, they're on high paying jobs, like maybe even over $100,000 a year in their salary. And they don't save like any of it.
Yeah.
Like some of them have massive credit card debt and cash flow negative. And it's remarkable because I look at that and I'm like, how you earn like $100,000 a year. That is, by Australian cost of living standards, that is a very large amount of money.
Yeah.
And it's just remarkable that they can't. And I think it stems from a fact that they haven't learnt the money, finance, business lessons that they needed to when they were younger to get them in that zone, like what you're just saying. And then it just blows my mind.
Yeah.
Because I try and think about it. Like if you make $100,000 a year and you don't save any money, what do you buy? It's like, how can you eat that much food? How can you buy that many clothes? It's like, I really want to know where your money goes. Are you just caught up in a huge amount of subscriptions that you just don't use or have forgotten about?
Yeah.
Are you a member of 5 different gyms? Like, it really blows my mind.
And the other thing to mention is that it's pretty much impossible to downgrade like your lifestyle once you've spent a certain amount of money and built your lifestyle up to a certain level.
It's a good point.
Yeah, I mean, I get really nervous for people who spend almost all or all of what they earn, because you should always be in a position where you kind of expect that you're going to face something in the future where you don't earn as much money. I think that's a good way to live. So people who are constantly spending everything they earn, that makes me really nervous, because if they start earning a lot less, which may very well happen in the future, can happen to anybody, then you're going to have to downgrade your lifestyle, and that is very painful to do. So I think that's just another lesson to sort of have to try and keep your expenses really low and be really hesitant to upgrade your lifestyle even as you're making more money.
Yeah. Like imagine if you're stuck in a situation where you're living in a huge house that you don't need and you're driving this ultra flash car that you're in so much debt for. I mean, it's a hard thing to sell your house and downsize and sell your car and downsize.
Yeah.
No, you're right. It definitely traps in a lot of people. All right. Well, we should move on to the next question. We're getting through them. We're doing well.
Yeah, we're getting there.
This is good. I'm having a lot of fun. This is fantastic.
Yeah,
we should do this every week.
Yeah, we really should.
This is great. So our next question comes in from an anonymous caller. So take it away.
Hey, congrats, guys. I'm reaching the 100th episode. Loving the easy to understand content you provide on value investing. It's very refreshing compared to all the dodgy stuff out there. My question is, even though the A2 Milk company only has 5 years of data, it has shown impressive growth rates in all of the big 5 numbers, has low debt and $850 million of free cash flow. Are there exceptions in determining a potential Rule 1 investment? And also, investing in a business before the institutions get in is ideal. A2 Milk's already got 60% institutional ownership. How does this affect its share price growth? Cheers.
Well, first of all, it certainly sounds like. First of all, thank you for your question, and it certainly sounds like you've done the research when it comes to A2 Milk. What I'd say about the kind of 5 years of numbers instead of 10 or more is that all of the guidelines of the strategy are there for a reason. So that there is a reason why we like to see 10, 15 years of data so that we can really we can see long-term trends. But when we go through this kind of rule 1 four-step strategy, a lot of the times companies look fantastic except for this one little thing. Do you find that as well?
Yeah. I mean, it's almost never the case that it's perfect.
It's never the case that you're going to get like 100% tick the green tick in every single box. There's always one little thing where you're just like, bugger, that doesn't quite fit. And I think there's kind of 2 ways that you can go about it. You can just approach it ultra conservatively and say, you know what, it doesn't have 10 years of numbers. That's it. I'm just simply going to put it to the side and move on because, I'm not entirely sure of that long-term trend. Or you can, on the other hand, you can accept the flaw and still go with it. But you only do that as long as you acknowledge that doing that has some sort of risk attached to it. So, maybe the, I don't know, what's a good example? Like maybe the return on invested capital has recently had a dip. It was great for a long time and recently it's dipped down maybe to 2 or 3%. Whereas all the numbers, all the moat numbers are there, the management team, their debt management's good. It's just the return on invested capital. This is the only thing, it's got good value. You understand the business. You can still go with it. But you have to really dive into why the ROIC dip has happened, and you have to accept that that's just a little bit of a risk if you were to continue and invest in that company. But I think there's got to be some room for to be able to flex, because I think if you just followed the strategy, if you almost treated it like a big list of checkboxes and you had to get a tick in every single checkbox, I don't think you could have maybe like one of the companies that is probably closest, maybe like a Google or a Facebook, one that like almost perfectly fits that kind of strategy. But I reckon you could still find some boxes that would get a cross in them, not a tick.
Yeah.
So, but yeah, what do you think?
Yeah, I mean, I think that the all of the different things that we look for when we're investing, it's kind of like a checklist of things to reduce uncertainty. And if
that's a good way to
all
look
of them
at it.
were satisfied, which, as we've both just kind of said, I don't know if I've ever seen a company where everything is satisfied. It just means you're finding a company with relatively low uncertainty compared to other investments. So you're never, like Brandon said, I won't repeat what he said, but you're never going to find a company that meets everything. So you just kind of need to balance those things. But personally, I really like 10 years of data. Because there is a significant drop-off in the number of companies that can grow consistently for 10 years versus growing consistently for 5 years. There's a lot of companies that grow consistently for 1 year, 2 years, 3 years, 4 years, 5 years, and that's it. Then they don't grow anymore. Whereas the number of companies that grow consistently for 10 years is a much smaller list. And if we're going to be investing over the long term, we're looking to invest over the next 10 years, then seeing 10 years of growth gives me confidence more than a business that's been growing for a shorter period of time. I mean, the other thing to mention is that as a consequence of the business growing really fast for a short period, for having 5 years of a spurt of growth, the stock's usually really expensive, right? You're usually paying up to invest in that company because most people are looking in the short term. They're looking at how can the company grow over the next couple of years, and as a result, those businesses that have a lot of growth over the last few years tend to be very, very expensive. At least that's kind of been my experience.
And something like an A2 Milk, where over the past 5 years has really come from nothing to being really something amazing. You're probably going to be seeing growth rates because it was a small business 5 years ago. You're going to see growth rates, that are quite impressive, I would imagine. So you're right in what you say is that the market will kind of price price the stock accordingly based on the growth rates that you would have seen. So, in terms of an Apple, it's going to be very unlikely, like Apple's not going to grow at an compound annual growth rate of 100% from now. But for a smaller business that's, it's much more likely that business could potentially double itself over the next year. So you're probably going to see very high growth rates, and you probably see very high stock prices as well. But yeah, you're right. There's definitely a case for maybe over the past 5 years isn't long enough, especially when the last 5 years has been like fabulous economic conditions. Access to capital has been quite easy. Raising money has been very easy. Taking on debt's been easy.
Yeah. And if you're looking at a company like that, typically the best time to invest in a company that's been on a really hot streak is right after that hot streak ends. Because if it's a really good company, no matter what company it is, there's going to be a period where their growth slows down before they can kind of continue to grow in a similar way as they have in the past. So waiting for that kind of cliff to happen where investors think that the growth is kind of completely ended, that'll usually result in the stock getting really, really cheap. I think that's what happened to Apple in 2015 when their iPhone units stopped growing for the first time.
That's right, yeah.
People panicked. The stock went down a ton. Same thing happened to Facebook in 2018. They didn't see user growth in Europe for the first time in their history, and people panicked. So it's happened. That kind of is what I look for. I didn't invest in Facebook until they had 10 years of data, first of all. And then I was waiting for something to happen. I knew it was a great business, but it was really expensive. So I kind of was waiting for there to be a misstep by the company, or just kind of some difference in their numbers, a slower growth rate than people were expecting. And all of those speculative investors will just run out of the stock. And that's when you as a value investor can get in. So, yeah.
True. Sometimes if you know the business well enough and you see 1 year of, like free cash flow and it goes down a lot, and you know that it's, even that, if you're strictly talking about that rule 1 method that, Phil Town likes to talk about, even like 1 year of below 10% growth in free cash flow would be a red cross. But you might know the business well enough to know that they're sinking billions of dollars into this massive expansion project that's going to lead to 5 times the revenue or something. So that might give you a little edge where you're like, oh, while everyone's panicking, well, actually, that actually this is going to be really good if I'm a long-term investor. If I can wait until 10 years until the fruits of the labor are being seen with this new manufacturing plant or whatever it is, then that can give you an opportunity as well.
Definitely. And just to answer the last bit of your question on institutional investors.
Yes. How does that affect the share price growth?
So I would imagine that in the short term, if a lot of institutional investors were coming onto that stock, it was on their radar now and they were investing in it, that would push the stock price up.
Definitely.
But over the long term, most businesses grow based on their stock prices grow based on the cash that they return to shareholders. So I would imagine that even if a stock goes up a ton because it's on the institutional investors' radar, that stock might go up a ton, but if the underlying business doesn't meet their expectations, then it could easily just drop off as quickly. So institutional investors coming on board, certainly you would think would have upward pressure on the stock, but once they hold the stock, they can also assert significant downward pressure on the stock by selling it in the millions. So that's just something to think about. And, over the long term, as a long-term investor, institutional investors isn't something I think about too much. I'm much more interested in the actual cash that the business produces, which over the long term will attract or detract those institutional investors that have most of the money in the market.
Yep. Sounds good. Thanks for the question. That was a really good one.
Yeah, it was.
All right, let's move into the next question. Next question comes in from Doug asking about ETFs. So take it away, Doug.
Hi, Hamish and Brandon. Doug Schiller here from Tasmania. Love the podcast. It's been a highlight of my Saturdays in 2020, that's for sure. My question is about ETFs. I think I understand how regular companies are priced on the stock exchange, but ETFs are a bit more complicated. Can you either explain on the podcast or make a video about the way the price of an ETF is set? Is it the weighted value of the ETF holdings, or is it the demand for the ETF itself that determines the price? Thanks, guys. Stay safe.
So firstly, thank you very much for sending in the question, Doug. You're right. ETFs, a little bit tricky to understand when it comes to valuations. So obviously we've got ETFs. They are just think of them as a big basket of stocks. So the ETF has bought shares in lots of other companies as per its investment objective. For example, VAS here in Australia mimics the ASX 300 index, so it buys the 300 largest Australian companies. You've got your market-weighted ETFs. So market-weighted is where the amount invested in each company is weighted as per the company's weight in the index. So if you bought an ETF that tracks the S&P 500, I actually looked this up. Microsoft takes up about 6% of the S&P 500. Wow. So the ETF is going to sink 6% of its cash into Microsoft. You've also got your equal weighted ETFs where money is dispersed evenly to each company. So 500 companies in the S&P 500. So you're going to get 0.2% of the funds would be invested in each company. So now to answer your question, talking about pricing of ETFs. So when it comes to pricing ETF, this is kind of flawed, but ETF buyers look at the net asset value of the ETF, which is just simply the value of all of the stock positions that the ETF holds. So say the net asset value might be like 500 million, and then the fund is broken up into like 500 million shares, then net asset value per share is going to be about, it's going to be $1. So the ETF will likely trade on the market at about $1 per share. Mm-hmm. However, because ETFs are just traded on the exchange, buyers and sellers set the price. So occasionally you can buy at a slight discount to net asset value, or what you don't want is buying a slight premium to net asset value. Traders, they kind of see this as a bit of like an arbitrage opportunity. They think that, they'd expect the net asset value to be perfect, but sometimes it isn't just because it's traded on an exchange. Sorry, this is a long answer, but I think it's important to go through it.
Yeah, definitely.
So essentially, the net asset value just shows you what the value of the investments are when you add them together, and it doesn't actually give you the flavor of the individual investments in the ETF, whether they are overvalued or undervalued. So to truly know the intrinsic value of the ETF, you'd actually need to value like every company it holds, which is... It's crazy. Like if you bought an S&P 500 ETF, are you going to value 500 companies? Like, I don't think so. So that's why ETFs don't really work when you come from an active investing mindset, when you want to buy cheap, undervalued stocks, because it's just obviously really hard to go out and value every single company that's in there. And net asset value doesn't actually give you the flavor you want on the value of what's in that ETF. So that's why when I'm talking about ETFs, I'm only ever talking about passive investing and dollar cost averaging, just where we look at the evidence of the underlying index over time. We buy parcels of that ETF consistently over time. Some parcels will be overvalued, some will be undervalued, but the point is we keep buying periodically to average out to the average return of that index over time, which you look at the historical data. If we're looking at the S&P 500, we know that that's 8%. Here in Australia, for some reason, we're actually a little bit higher. We're like between 10 and 13%. But yeah, sorry about that being a very long-winded answer, but no, I hope that helps.
No, that was brilliant. I would do you a disservice if I added anything to that or just repeated anything that you said. So I'll completely leave it at that. I think that was a really good answer.
Did I get that right?
Yes.
Is there anything? Yeah,
that's my complete understanding of ETFs. So
okay,
yeah,
all right, cool.
All right.
Well, thanks Doug for the question. I hope that helps. But yeah, overall ETFs very hard when you're coming at them from an active investing mindset. So probably for ETFs, just come at them from more of a passive investing mindset, I'd say.
Definitely. Yeah. All right. We'll move into the next question. So the next question we've got here comes from Stephen. This is question number 7. So take it away, Stephen.
Congratulations, Hamish and Brandon, on 100 episodes. It's a huge milestone, and I hope you keep up the hard work. So I have 2 questions. One is, what soft skills did you improve on during your start of investing till now? Do you find that you're communicating a lot better? Do you find that your confidence is building a lot more? And second question is, how did your investing progress change your lifestyle? Did you find the conversations with your family quite different? Or possibly you could have changed your social groups? Personally, I started my investing, journey during the lockdowns as a lot of other people. And I've noticed in the past few months, especially, I've been branching out a lot more to people that I wouldn't used to, and also having a lot more deeper conversations with my social groups these days about thinking about why and how and really trying to get a perspective on things. All right. Thanks, guys.
Thanks for the question, Stephen. I think there's a couple of things. I used to hate reading. I would read nothing at all.
I'm the same.
And I still don't really like reading a lot, but sort of finding things that I like to read about has really encouraged me to be reading regularly on a daily basis now, really, whether it's an investing book that I'm reading or whether it's an annual report or it's just an article that I'm reading. Whatever kind of reading it is, I'm doing a lot more than I used to. And I'm sure that has an impact on a number of different skills, communication skills and literacy and that sort of thing. In terms of communication skills specifically, I think that because of YouTube and the podcast, I think I've certainly improved in that area. I'm very introverted, just by nature. So, having the podcast and YouTube particularly the podcast, I think where you're forced to kind of think on your feet a little bit, ask more questions and be a little bit more critical in your conversation. I think that has helped a ton. Other areas, I think one area investing has changed sort of my lifestyle is how I think about my career. So I think like a lot of people, when I was growing up, I had a very linear idea of career. I kind of saw career as you go to school, then you go to university based on what you're interested in, and then you use that piece of paper to get a job. Whereas now, and this is also part of just the nature of what we do, not just investing, but the fact that we're both running our own businesses, is that I kind of see things now more in terms of return. I think about whenever I'm doing something, I'm thinking, what kind of return am I getting on my time spent doing this activity? Whether it's something that's going to benefit my business or something, whether I'm making a YouTube video or something, or I'm deciding between which YouTube video to make. I'm just thinking about return. What return am I getting on my time? And that doesn't necessarily need to be in terms of money. That can be, other kinds of return. But and then also just thinking about return strictly in terms of money. Things like if I'm buying this asset for my business, if I'm buying this new light, if I'm buying a Tesla, well, that's not really for your business. But if you're buying an asset or whatever it is that you're buying, what kind of return are you getting on that? And I think ultimately the way that I would describe that is that I think investing helps you make better decisions. I think it makes you think a little bit more critically. Do you think that's the case? I think about the opportunity cost.
Think about things in a different way.
Yeah, I think more about weighing options, about the opportunity cost of making a decision. What can't I do if I make this decision? What am I foregoing? And I think those things are very valuable. Yeah. What do you think?
I think I pretty much agree with what you just said. In terms of skills that improve from investing, I think like obviously critical thinking, your analytical skills, trying to wrap your head around fully functioning businesses is decently challenging. But I think in terms of more of those social skills, like the confidence and the speaking ability and that sort of thing, it's I'm still pretty bad with the speaking, but that stuff comes from definitely from doing the YouTube channel and the podcasting. How has my lifestyle changed? It's changed for the better because when you invest, you get more money.
That is true.
No, but in all seriousness, it's changed. It's the main way it's changed my lifestyle is like what you're kind of talking about. You're thinking about your return. It's made me realize that just the time value of money, and that $100 you earn today is obviously much more valuable to you than $100 you earn 10 years from now. So that's really been a big eye opener. That with the compound interest kind of thing, it's really made me made me respect and value getting money sooner, I suppose. In terms of other lifestyle things, one thing that about my friendship group is that I used to be the only one that would be interested in business and investing. And I think that's like why this podcast even started, is because we wanted to talk, like we just didn't have anyone to really talk about business and investing to. So we thought, all right, well, we better just talk to each other about it.
Yeah, I spent way too much time boring my parents and my friends just talking about finance, and they'd be like, yeah, okay.
Yeah, exactly okay, right. And
dude.
I mean, my parents would try and like kind of stick with what I'm talking about, but there's only so far that they would there's only so much they would politely listen to before they were just like, Brandon, I'm trying to watch Gardening Australia here. But yeah, I don't know. It's been really good that I think that I've actually gotten some of my friends into investing. Well, I don't know if it was me specifically, but a few of my friends have started investing. So now that a few people in my friendship group are much willing to talk about investing and have a chat about it. So shout out to Steph and Matt, Mara and Alicia.
Yeah, I mean, I love talking to people about investing. If anyone ever, like a friend from high school or anything like that, reaches out to me, which happens from time to time, and says, "Hey, what's your channel? Like, what do you think I should do?" Like, I just love like kind of teaching people the basics of finance and investing, and that's certainly something that's changed over the past few years. That certainly wasn't something I was doing before.
But yeah, overall, thanks for the question, Stephen. Super appreciate it. And moving into the next question comes in from Tobias. So take it away, Tobias.
Hey guys, I've been enjoying listening to the podcast, and a huge well done on reaching 100. I think that's quite an achievement. My question is this. I've relatively recently finished reading Phil Town's book, Rule Number 1, and in a basic nutshell, he advocates getting into stocks or out of stocks that are quality businesses based upon 3 tools, being the MACD, the simple moving average, and stochastics. I'm wondering if you guys utilize these tools in your investing and any other thoughts that you might have on them.
Thanks for sending in the question, Tobias. To answer your question, I actually don't think Phil uses the 3 tools as much as what he used to. Definitely in that first book, he advocates dancing in and out of the stocks that you like when the indicators tell you to. But the interesting thing to remember with his first book is that he comes at it from a perspective that he's copping no tax consequences for doing that, because he's doing that strategy within a special type of retirement account, which is called a Roth IRA, that doesn't cop the tax consequences. In terms of me personally, like I definitely still look at them a lot. I don't follow them as rigorously as like what Phil preaches in his first book. But if I'm just much more about the margin of safety. So if I've got this great business that I understand, it's got this great moat, management team's doing wonders with the company, and it's come on to that margin of safety price, I will kind of use the 3 tools to give me an inkling of about the best time to get into it. But that's just about when, I guess sometimes I follow them if the stock's gone really overvalued, really expensive, then I might use them to try and time my exit as well as possible. But overall, I don't want to put too much emphasis on them, because I think the much more important thing for long-term value style investors is to just make sure that you've got the understanding of the business, the moat, the management. Okay, the margin of safety is the important thing. Making sure that you're getting those. More importantly than whatever the indicators tell you is just make sure you can buy at a margin of safety price, because I mean, the indicators are good, but they're not perfect. And sometimes you see them give off little false positives, which can trigger you to do something when in actual fact, it didn't actually indicate what the indicators were supposed to. But overall, I put much more emphasis on just trying to find margin of safety.
Yeah. Okay. Yeah. I'm probably pretty similar. I don't actually use them at all. So that's a little bit different. Yep. But the interesting thing about Phil Town is he wrote that first book, I think in 2004. And he speaks, it's quite a big part of that book is technical indicators, like using these indicators to get in and out. And then his second book, Payback Time, I think that was 2009, I think just after the GFC or around that time. He doesn't talk about them at all. And in
fact, he ditched them because he spoke. Yeah. He goes with the idea of loading up.
Yes. So he instead teaches a method of he calls stockpiling, which is whereby instead of trading in and out, when you just add more when they get cheap. So instead of trying to get in and out of these great companies, your goal is to accumulate as much wealth in those businesses by only buying them when they get cheap enough. And that's the method by far that aligns with mine. That aligns with mine. I don't look to sell great businesses. I want to hold on to them. If they get really expensive, which means that, if at that current price, I'm expecting to make less than a 5% return per year on that stock. So its stock has gone up so much that all of that return has been kind of gained already, then I'll sell something. But other than that, I mostly just want to hold on to great businesses over the long term. So I personally don't use technical indicators at all.
Okay. Fair. All right. Well, that wraps up that question. We've got two more, and then we'll wrap things up for episode 100. So next one comes in from Andy. So take it away, Andy.
Hi, Brandon. Hi, Hamish. Congratulations on reaching 100 episodes. Keep up the great work, guys. My question to you both is, do you own any non-share investments, such as commodities or property? And do you think the average person should be invested in these type of assets? Or is a well-diversified share portfolio alone sufficient? Thanks.
Thanks, Andy, for the question. So personally, do I hold any non-share investments? No. So at the moment, I just have my share portfolio, which is mostly individual businesses, and then an index fund as well, or two index funds actually, one that tracks the Australian market, one that tracks the US market, and then I hold cash. So I don't actually hold any. In terms of sort of thinking about investing in other types of assets, I think it depends on what types of assets. Commodities, for example, before I go into commodities, I really like cash producing assets. So I like businesses, I like properties. Commodities doesn't fit into that. It's not an asset that actually produces anything. If I buy that commodity, besides being able to sell it to someone for more, it's not going to do anything for me. Whereas when I'm buying a share in a business, even though, in reality, I do need to sell that to somebody else at some point, even if I'm not selling it, there's a group of people, there's machinery, there's buildings that are all this kind of machine that's pumping out cash. And that's something that commodities don't have. So I like cash producing assets. And do I think that the average person should be investing in these assets? Well, I think it makes sense to get diversification on a number of different dimensions. So diversification in the different businesses that you have, different sectors, diversification in different countries if possible, or different currencies. And I think the same thing is true for asset classes, getting a diversification in a number of different asset classes. But with that said, obviously it's quite a big step up to invest in a property compared to buying shares. You could have a $100,000 share portfolio, and then if you're going to add a property to that, the property is going to be like 90% of that portfolio. But certainly I think that getting asset class diversification is something that you should strive for over the long term.
Yeah, definitely. I think that you could definitely do very well with just a diversified share portfolio. Like, you could definitely get a lot of diversification out of a share portfolio. But yeah, I mean, you're right. There could be some, sweeping market-wide event that affects every business, and then all of a sudden that doesn't look so great. So yeah, I mean, personally, I'd love to have some diversification into property. I know that you can diversify into property through the stock market, like with your real estate investment trusts and whatnot. Yeah. But I think if I was going to get into property, I'd just do it the old-fashioned way, and just own property, own those properties and have tenants. And yeah, I think, I'm not a huge fan of commodities or even, companies that produce the commodities, the oil drilling companies or whatever, just because like a lot of those businesses, there's no moats there because they're all making the same thing.
Yeah.
Yeah, like what you say, I think both of our investing strategies, we could really boil it down into 2 words: cash flow. Now I'm thinking, is cash flow 1 word or 2 words?
I don't know, actually. Is it 2 words?
I don't know. Is the cash flow statement?
Maybe it's 1 word.
Anyway, it all boils down to cash flow. I think that's really that's probably what would come almost number 1 for us.
Yeah.
We like investments that we can model and that will give us cash back over time, and we'll start making more or keep making more and more cash. So that's why we really like businesses or shares. And I can definitely see myself owning property as well in the future, but I don't think I'll ever own gold, oil or anything like that. It's just that classic Warren Buffett. What does he say? You could fit all the gold in the world in a 90 square foot cube, I don't know, between home base and first base on the baseball field or whatever. And
wow.
Every night you could have all the gold in the world, and you can go and you can fondle it, you can give it a hug, you can sit on it, you can, do whatever, give it a kiss. But at the end of the day, I mean, that's all you can do with it. That's all it's going to ever be there for, is to look shiny and look pretty, or for that same block of land. I think his analogy was you can own all of or for the same value, you could own all of the farmland in the United States and 5 Exxon Mobils or something like that. I think that was his analogy. It's like, what would you rather? Personally, I'd rather own a different company than Exxon Mobil, but I'll definitely take the farmland. Because all the Exxon Mobils and the farmland, it produces cash flow. So yeah. That's how I think about it. Yeah. All right. We're down to the last question, Hamish.
Yes. We're at the end.
The last question. Last question comes in from Cameron from South Africa. I didn't know we had any viewers in South Africa.
Yeah, that's
awesome. All right, Cameron, take it away.
Hey guys, Cameron Mangold here from South Africa. I apologize for your recent performance in the Rugby World Cup, but that's besides the point. I just wanted to ask about an investing platform that recently launched in Australia called Easy Equities. I just want to know, do you recommend it and why? And if not, why not? Thanks, guys, and thanks for the show. Really enjoy it.
Thanks for the question, Cameron. Also pretty cheeky about the Rugby World Cup, but I'll just let that one fly on by. With what was it called? Easy Equities. I haven't used it before, so I can't really make a comment either way. I did have a quick look at it before we started the podcast just to get a feel for what it is. It just looks like it's a new kind of up-and-coming low-cost brokerage site. But I don't want to recommend it, nor do I want to not recommend it, just because I don't really have an experience with it. The only thing I would say, this is kind of going back to what we were talking about last week with Robinhood. With a lot of these low-cost brokerage options, you just got to be careful what you're sacrificing, because obviously at the end of the day, they need to make their business work financially as well. So for like the Robinhood, you get less customer service. You can't walk into the branches like you can a Commonwealth Bank or something like that. So I just take some time maybe with the up and coming low brokerage platforms just to think about what am I sacrificing for the fact that I have to pay less in brokerage. Another thing to consider is with these really new brokerage sites that not many people are using, is that what happens to your money if they go bust? So is your portfolio insured so that you still get all of your cash if they go bust? That's a query that I had when I first started working with Stake, and then they took me through the process how actually they have insurance up to I can't even remember how much, but it's a huge amount for everyone's portfolio, so that if they went bust, then you would not go bust. So some of those things to think about, but I don't want to knock it, but I also don't want to recommend it just because I haven't used it. Do you have any other comments on new low cost brokerage up and coming kind of platforms?
I mean, in terms of Easy Equity specifically, I haven't tried it or looked at it at all yet. So same as Brandon, I can't recommend it or not recommend it. But yeah, I mean, I think I spoke about this a little bit last week when we were talking about Robinhood. I think that the low cost free brokerage trading platforms, I think they're good for people who are just getting started with a little bit of money. You're kind of just dabbling in the market, but if you, and this is just my opinion, but if you're investing a substantial amount of money, I much more would rather pay a little bit for brokerage in exchange for having customer service that I know is always going to be there, and the added security as well. So that's kind of my position on it, but I haven't looked into easy equities before. I'll have to check it out.
Yeah. Well, guys, that will just about do us. What an episode.
Wow, yeah.
Man, that was just so much fun.
Yeah, we're definitely doing this. We're going to try and do this again at some point.
Yeah,
whether that's we can regularly do it, I'm not sure, but maybe we can do an episode every now and then at least. Maybe every now and then we can get some questions in, let them build up a little bit, and then do one of these again.
Yeah, actually, that'd probably be a good idea. So we'll probably keep mentioning it, and then we'll come back and we'll do a Q&A specific episode. Yeah, it's a good idea. So yeah, if you have a question and you'd like to send it in to us via audio, then just record it on whatever device you've got, and then just email it to younginvetorspodcast@gmail.com. And we will be back next week for the really big episode. You thought episode 100 was big. Episode 101.
Wow.
That's where it's at.
Road to 200.
Road to 200 starts now. Here we go.
God, it's like 2 years away.
Man, I know we say this a lot, but it just goes back. 100 episodes. That's like 100, more than 100 hours of content that we've made just on the Young Investors podcast alone.
Yeah.
It's insane. How have we had that much to talk about? I don't know.
Yeah, how have we actually? It's amazing.
It's pretty insane. We somehow find, and it's some days we think when we're going to talk for like half an hour, but it always comes in at about an hour.
Yeah, we always find something to ramble on about. It's always something.
It's true. It's true. Yeah. Anyway, guys, thank you very much to everyone that submitted an audio clip. We certainly appreciate it. You guys have really made this episode something special. So definitely thank you very much to everyone that sent in an audio clip. And thanks everyone, that's been a listener, every week, just showing up and supporting us with an hour of your time and giving us that view. And we hope that you have enjoyed the podcast over the first 100 episodes, and we'll certainly keep going with many, many more episodes into the future. So we certainly definitely appreciate your support. It definitely does not go unnoticed. So we appreciate your support and everything that we do and helping us, enabling us to do what we want to do for a living, which is podcast and YouTube and all that sort of stuff. So thank you very much for your ongoing support, and here's to many more fantastic Young Investors Podcast episodes into the future.
Thanks everyone.
Yeah. Thanks Hamish for joining me as always.
No
and thanks to Sharesight also for sponsoring the episode. And that will just about do it. That wraps up episode 100. So with that said, we'll see you guys next week.
See you guys.